Hello, good afternoon. My name is Natalie Colley. I am a partner here at Francis Financial and a senior lead advisor, and I am joined by our esteemed Chief Investment Officer, Matt Haertzen, and as he mentioned, who has decades of experience guiding investors, individual investors, all the way up to institutional investors on how to invest. So he is going to share a lot of his wisdom with us today.
Great. Well, thanks. It's great. It should be a lot of fun. It's certainly been a good year to have at least something to talk about from a market perspective.
You know what? That is true. It's given us a lot to talk about. And with that, let me go ahead and share my screen and we can just dive right in. So, managing market fluctuations with confidence. And we certainly hope that you leave this presentation today feeling a lot more confident about how your portfolio is positioned and how to manage the stress that can come along with this kind of market volatility. And certainly there's been a ton in the media about a lot, market included. So what we're going to review in today's presentation is, recent market performance year to date. Feels like a lot has happened. What is driving the volatility? Some smart strategies. What do we do with this information? How do we apply it to our portfolios? And some key reminders, some historical data that can help us to put into context what we're seeing today and therefore what we might expect going forward. So Matt, I wanted to start out, if you could describe in one or two sentences the market year to date, what would you say?
Nothing's happened. How about even two words? If we look at performance, not a lot has happened. There's been a lot of information, a lot of headlines, a lot of noise. Natalie, as we were preparing for this and we talked about that, it doesn't seem like it's only been 3 months. There has been so much that's happened, and we're just getting to the end of the first quarter this year. But this slide that you've pulled up here, I think really highlights it. We've seen a little bit of a correction in a snapback there. If you look at large cap growth on the left, we're on a year-to-date basis is down about 5.5%. But if you remember, last year, large cap growth stocks were up over 30%. So correction was probably expected there. The area that you boxed in here in the center, I think, is really the important part because most of our clients do have nicely diversified portfolios. We've never been one for putting all of our eggs in one basket, even with Easter coming up. And well, as expensive as eggs are now, we probably don't want them all in the same basket anyway. But with a nicely diversified portfolio, what you see is you're basically flat for the year. So despite all of the noise, all of the headlines, nothing's really happened.
Yeah, I kind of have two takeaways from this chart. One is so the dark teal columns, that is the 1 year performance in all of these various asset classes. And then, as you pointed out, the diversified portfolio is the blend of all of them. And like, I'll take it. That's really good performance, 8.8% for a balanced 60/40 type portfolio is very good. So it's nice to put it into context, to zoom out a little bit. And then also the second is that you can see all the way to the right, international stocks, 8.3%. I think international stocks have, maybe rightfully so, been ignored or they've definitely fallen out of favor the last 10-15 years because of the US market outperforming so strongly. But it's nice to see them add to that diversification and also acknowledge that they're performing quite well also.
Yeah, no, I think that's a really important point is as you look at that diversified portfolio, a lot of the clients who are on the call have probably heard me say this before, but the way you tell you have a well-diversified portfolio is you hate something in your portfolio all the time. And that means they're not all moving up together, which means they're not all falling together. And certainly if you look at those international stocks, that's been something we've had a lot of client questions. Why do we keep making those allocations international? And at least on a year-to-date basis, probably too early to call it a trend yet, but we do see some fundamentals that have shifted, and certainly from a performance perspective, see international stocks up almost 10% year to date. We're really, really pleased with that.
Yeah, and along the lines of zooming out a little bit and what a difference it makes, we've heard a lot about February highs and news of a correction. And it really has me thinking these days that when, it's the media loves to highlight how far has the market fallen from recent highs. So I think some of the people on this call, myself included, until I was really preparing for this presentation, may forget that the market was continuing to experience new highs all the way into mid-February. But if you listen to the media, they love to talk about, anchor to the most recent high and talk about just how far the market has fallen. But if you zoom out to year to date, like we just showed, I mean, the market is flat in a diversified portfolio. Yes, some asset classes have experienced larger losses, but I just love that trick of like calling out the NASDAQ, which of course is focused on tech companies, which have fallen the most. And you're going to hear in the media just how dramatically the NASDAQ has fallen from its peak. And I was thinking this morning, I went for a run and I was thinking about how that would be like me running a marathon and talking about how I had a 6-minute pace. Like, yes, I can probably run a 6-minute pace downhill with the wind at my back in the first couple of miles. But that's certainly completely out of context, right? Like you look at the average pace over the entire marathon and it's just struck me as very similar here.
Yeah, we have to remember that all these television channels that we're watching, they're trying to sell advertising, and sensationalism sells. And so it sounds, what is sensationalism, excitement or fear, right? Those are the two things they're trying to sell in this case. And it sounds it drives a lot more fear, a lot more viewership, a lot more eyeballs on the screen if we say, oh my, we've hit a correction in the market. And for those who are listening who aren't familiar with the term correction, sort of an investment term, when we fall 10% from the high, that's considered a correction. If we fell 20% from the high, that would be considered a bear market. But so yes, technically for a few short days, we did hit a correction. And as you pointed out, really emphasized from the media out there, whether that's in print or online or on TV. But with what's really happened during these first 3 months of the year, overall diversified portfolio looks really good. And if I think, we highlight a couple things here, bonds, everybody hated bonds, particularly after 2022 when interest rates were moving up so dramatically. They've provided a really nice stabilizer to US stocks this year, up about 2% year to date. We talked about developed international before, and even those emerging markets, and a lot of investors have given up on emerging markets, though we still feel they play a really critical role. I was surprised by this number. You mentioned being surprised, Natalie. I was surprised by this, and that's why I put it in the bottom here in bold. Over the last 12 months, emerging market stocks have been the best performing asset class, up about 12.5%. And I don't know if you have, I follow this. I'm in the markets obviously day to day. That's my job. That still snuck up on me. And I know from Francis's perspective, we're big believers in the emerging markets and the long-term demographic trends there.
Yep, absolutely. And it just goes to show the fact that this could be, a surprise or sneak up on you. It really does make a difference what you pay attention to and what you're consuming day to day, right? If we were in an emerging country, perhaps this wouldn't have been a surprise. We would have been cheering all the way. Who knows?
Yeah, absolutely.
So we know that where we are right now is in a pretty good spot when we zoom out a little further. So what is driving all of the market media chatter and volatility?
Yeah, so our word of the day, if you'll pick our word of the day, is uncertainty. And so what we have in the market today, and with the new administration, obviously being in for just a little over a couple months now, settling in, trying to get their policies implemented, feeling their way through, is a lot of uncertainty. And so the biggest one, and we have this coming up next week, April 2nd, I think exactly a week from today, if I remember my calendar correctly, we're going to have this idea of expansion of tariffs. And so that's something that really all business people as well as all investors are watching pretty closely. Associated with that, we also have some layoffs that are taking place, certainly seen some headlines on government employee cuts, those sorts of things. Changes in immigration policy that have led to some pretty substantial deportation. What's that going to do to the labor force? On the maybe a little slightly more positive note, a lot of discussion around simplification of the regulatory environment, trying to maybe improve the environment from an overall business perspective, and then an extension of the existing tax cuts. And as I said, we're monitoring this every day. One of the things that I thought was really interesting there was Yardeni Research here put out a note on the Fed meeting that wrapped up last week and highlighted they actually went through and counted, and I'm assuming maybe they used AI for the counting, but they went through and counted that Fed Reserve Chairman Jerome Powell actually said the word uncertainty 16 times in the press conference. And I don't know if you remember, Natalie, but that was a relatively short press conference. And so 16 times that particular word came up, which really leads to, and I think you wanted to talk about a couple examples of just how much uncertainty is out there in the marketplace today.
Right. And of course, this uncertainty trickles down into the business community. Originally, after the election, very excited about possible deregulation, which you mentioned, but now a lot of uncertainty about where policy is headed and how that's going to impact companies. And the problem for the business world in particular is really that they plan many, many years, if not decades in advance. Where are they going to build their next manufacturing plant? What parts of their business are they going to lean into? I was an engineer for the first decade of my career, and in 08, 09, 2010, we were actually fine because companies had laid out the capital expenditures, 5, 10 years, if not more, prior to the economic downturn back then. And we started to see some of the implications of 08, 09 many years later when companies stopped. And so that's really the problem that we're seeing from a corporate perspective.
Yeah, and what you see highlighted there just in the yellow, just to make a quick reference to that, is this is from the ISM, this is a manufacturing report, and just a small group, and I highlighted those in yellow of that exact highlighting that point that you made there, that it's hard for companies to plan. We have some of the the best companies in the world here in the US. There are obviously some great companies beyond the US as well. They can adjust to most things, but what they can't adjust to is what they don't know. And that's the challenge I think we face today. And the next chart that you got to there just kind of highlighted that even as the Fed's talking and they're thinking about it, they're referring to uncertainty as well. And so right now, that's really the environment we're operating in. That's why it is certainly our word of the day. This one I thought was really interesting because this came out of last week's Fed meeting. And these are the members of the Federal Open Market Committee, and 4 times a year they give their interest rate forecast. It's commonly referred to as the dot plot. Interest is certainly followed very closely by investors on both the stock and bond side. And what you normally see, all of these dots, just to give everybody a little bit of an explanation, all of these dots are different people giving their votes as to what they see. So you can see there in 2025, there are 4 dots between 4.25 and 4.5. So thinking at the end of 2025, that's where the Fed funds rate is going to be. What's really interesting about this to me is as you look out at 26, 27, even longer term, look at how much dispersion there is between those dots. So these are the members of the same committee talking, working together, and they still have a lot of difference. Normally what you see is a much tighter grouping on these dots. And so I think that is just another way of kind of highlighting the level of uncertainty in the market today. So what does that translate to? I mean, so if we say there's a lot of uncertainty, we have to figure out what to do with that. How do we sort of think about that from a market perspective? And one of the things we've started to see is early signs of maybe a little bit of slowdown in the economy. And so if you look, this is actually from the Fed as well. And so when they met in December, so just a quarter ago, that's the dark teal lines there that you see on the chart. And you can see that they're forecasting 2.1% growth in 25, and then so on and so forth through 26 and 27. And you can see that growth level has come down a little bit. They're now that 2.1 forecasted to be a little closer to 1.7 for this year. If we move forward to that next page, Natalie, we can see they're starting to see some revisions of companies reducing their profits, bringing those down on an overall basis. And then on the next slide, we get into a little bit of consumer sentiment as well. And so consumers are a little bit worried about losing their jobs. And remember, this is just what they feel. This isn't consumers actually losing their jobs. In fact, we've seen employment remain very strong. But those who are worried about that, you can see a really sharp tick up. And Natalie, I think that change in expectations really sort of potentially drives future performance. And we've seen that in the past.
Right. And what I like to highlight about these last several slides and the few to follow is, these are how people are feeling. And I think it's sort of funny to me because we take these data points as fact. But if you look at this chart, for example, this is about the job market and people's expectations or concerns about losing their jobs. So it's not actually the unemployment numbers, right? It's that you have a lot of people who are now hearing about layoffs. Maybe their companies are participating in layoffs, or maybe they're just in general very concerned. But that's an important data point still because it does inform how people are going to spend their money, what kind of vacations they're planning, etc., planning their financial outlays for the future. And what I found very interesting about this chart, actually, which is why I'm hanging out here, is that we can see that even there's a higher percentage of people who are concerned about losing their jobs now, even than in 2020. So that actually did surprise me. And this is sort of a double whammy because this actually is data. And this chart shows the probability of households who are able to come up with $2,000, an unexpected $2,000 expense. If that were to land in their lap, they need to go get their car fixed or something like that. That number we have seen drop pretty steeply, down to only around 63% of households would actually be able to come up with that money. So that really is a data point, that combined with, I'm sure, the fear of what's going on in the economy is likely we would expect to have consumers spending a little bit less. And so it's really no surprise that we see this is a consumer sentiment chart, a really steep decline in people's confidence, consumers' confidence in what's going on in the economy right now. And we see that just, basically at the end of January until now.
Yeah. And I think that's a really important point to note is consumer spending makes up about 2/3 of our economic growth. And so even relatively modest slowdowns, as you're talking about, where people just become a little more cautious, can have an impact. And I think that's why you're seeing, when we looked at that Fed chart number, them bringing that GDP growth down just a little bit. And you've also heard it anecdotally, as Delta Airlines CEO was out saying they're starting to see a little bit fewer bookings, from an airline travel perspective. People seem to be slowing down, taking a more cautious approach. And Natalie, you talked about it from a business perspective. Businesses are kind of in a wait and see mode. We can't plan because we don't know what the tariff policy looks like, some of those things. Let's wait and see. And I think consumers are probably doing a little bit of the same, with their budgets as well. And I think some of this even ties back to what we started with, which is that extremism in what we're seeing in the media. And even if you haven't been directly impacted by a layoff, maybe you know someone who has, or you've just heard the talk about it enough that you're getting more concerned yourself as well.
Mm-hmm. And then at the same time, with consumers feeling like they might be running out of money, feeling like they're concerned about their being laid off or let go. We have a lot of concern about inflation right now.
Yeah, and so everybody we joked already to start about the price of eggs, but certainly that has been a focus in that we saw just an uptick there earlier in the year in some of those headline inflation numbers. And so that got investors concerned. Now, the most recent number we saw actually brought that back down again here as the data from February was released. So a little bit of calm, but again, this is what people feel. This is not what the actual data shows. This is what people feel may happen, and they continue to have concerns. And again, I think I would blame some of this on sort of the polarization of the media today, of really sort of pushing this narrative beyond the data of these prices are going to start picking back up. And so, certainly something we're watching very closely. Certainly we don't expect that we're going to see inflation tick back up to those, 6, 7, 8, 9% numbers we saw. But we would definitely like to see that trend of downward movement continue as we go forward.
And it's interesting to look at this slide where the expectation is basically going to the moon versus the FOMC dot plot that you shared, which is the FOMC members themselves having this expectation that they're going to continue to lower rates. It's interesting to see the two. And you actually shared this with me yesterday, which I thought was very interesting to put tariff talk into perspective, because obviously tariffs are one of the primary reasons that investors are fearing that inflation is going to take off. So can you sort of explain what we're looking at here a little, Matt?
Yeah, no, that was one of our key buzzwords there under uncertainty was tariffs. And I think this chart was sort of interesting in putting it a little bit in context, in that if you look at the US, and we highlighted that in a red box, I guess, here, as we're looking at that, right now, even with some of the adjustments made, still relatively low from a tariff rate perspective. Actually, not right now. This is 2023 data that we have from a charting perspective as we're looking at things. But we started from a really low base relative to the rest of the world. And so, yes, tariffs are concerning. And yes, we certainly think they'll be inflationary, and some of that will drive some inflation as we go forward. But we aren't talking, even moving up from where we are, we're starting at such a low level that compared to the rest of the world, we're still going to be pretty attractive from a tariff perspective. And so I think that's important to understand, again, in terms of putting really in context what we're specifically talking about here with a tariff.
And speaking of the rest of the world,
Yeah.
why don't you jump into this one a little bit?
Yeah, so there's too much on this, and I apologize to everybody who's looking at this particular chart. But what I thought this did a nice job of highlighting is the reaction of the rest of the world to some of the isolationist policies here within the US. If you look specifically at what's happened in Germany, is what we're showing there on the left. And what you see is, most of you probably know, they just had an election. And as we went into pre-election, we actually thought their spending as a country was going to come down. You can see a light gray line there kind of moving up a little bit in the dotted area. Post-election, we said they'd spend a little bit more, but now, as we've started to move into some of this particular concerns about, what role does Europe need to play to operate independently? Can they rely on the same level of support from the US? You've seen that Germany actually just passed a pretty substantial spending bill, significant investments in defense, but even beyond that, looking to drive some serious economic growth there. And so if you move to the right, and this ties back to where we started with our optimistic outlook for international stocks, you can see here, this is the European Union area there, and you see how new forecasts have moved pretty substantially higher for economic growth in this region. Now, it's important to understand these are positive growth that we're expecting to see here. We expect this growth to pick up as we go forward in that region. And that's a pretty substantial change compared to where we were, 3 to 6 months ago. And you can especially see that with that new forecast in the dark blue as we move into 25, 26, 27. Forecasters are now expecting much more substantial growth in the European area as they invest more, particularly in the defense arena, but also throughout their economies. And we've also seen early signs that we're starting to see some of the regulatory reform that we think needs to take place there to make this a better environment for businesses to operate as well. where they can now rely less on the US. They're starting to take a little bit more of an independence approach, and we think that could really drive some growth as we go forward. So when you're looking here, we're seeing a pickup in growth in the EU compared to what we showed you earlier, where we're seeing potentially declining growth in the US, and we really see this as an attractive investment opportunity going forward.
Once again, it's nice to see the role of diversification in a portfolio, especially after the last 10 to 15 years of absolute US dominance.
Yes.
So walking through all of that, everything that we're sort of thinking about and all of the noise that the media is focused on, how do we then apply this to a portfolio? Matt, obviously, you know exactly what's going to happen. So tell us how are we going to win the next decade?
Perfect. Well, first of all, I think you missed the word of the day, which was uncertainty, Natalie. But based on uncertainty, I wanted to give a bit of context as we started here. And so this is a survey that Goldman Sachs does with their big January Global Strategy Conference. And they do this survey every year. And what they ask is the US going to be the best performing equity region for that calendar year? So if you look back, we'll just go to the top at 2018, about whatever that is, 16% of the respondents said the US is going to be the best performing market. And you can see that that kind of held steady in that 15 to 20% range. Interestingly, 2022 was a bit of an outlier where they were more optimistic about the US, ended up being a terrible market for US stocks. But what I wanted to draw your attention to is 2025. Well, we can probably build from 2023. So good stock market year in 2023. Not a lot of people expected the US to dominate, but they did. More than as 2024 started, thought based on the great year in 2023, we're going to see an even better year in 2024. And so they had over 30% of the people picking the US to be the best market. Then as we started 2025, coming off of two really strong US stock market years, over half, almost 60% of the people in this survey said the US was going to be the best market this year. Moral of the story, you said I have all the answers. What's the moral of the story, Natalie?
We are all just sheep following the herd. And I mean, I love this slide because it, to me, illustrates the unconscious bias that we all have of anchoring. So, using whatever data we have from the most recent past to predict and project into the future. Worked great for caveman days, works really awful when applied to the market. But yeah, to your point, 2022 was a terrible year in the market, very, very painful, pretty much across all asset classes. And so very few people were willing to say, yeah, definitely it's going to be a great year and US is going to outperform. But then coming off of, 20+% year in the market in 2023, more people in 2024 jumped into the boat. Coming off of another 20+ year in the market in 2024, pretty much everyone has piled into that boat. And it's just a great example of anchoring. I get a kick out of that slide. I'm sure next year it will have dropped significantly. And just another, oops, jumped ahead a little too far. This is another excellent slide, very entertaining, which sort of shows the expert expectations at the beginning of the year of where we're going to be, where the S&P 500 is going to be by the end of the year. And you can see it, ranges from a loss of 3%, very modest loss, all the way up to 25% growth. And Matt, I'll let you have the punchline here.
Yeah, so back to knowing what's going to happen. The average estimate is for 15% growth. If we get a 15% year number this year, I think I'll certainly be thrilled. I hope the clients will be thrilled as well as we're working through that. But more importantly is uncertainty. And this was a quote from the Man Group. Predictions frequently miss the mark. In every year since 2016, the actual market return measured by the S&P has finished above the highest forecast, so above this 25% number, or below the lowest. So that's how often these predictions are right, which means basically never. Tying back to the slide, I know, which is your favorite slide you were already trying to jump to, why it's so important to diversify.
Yep, exactly. This is the quilt. We love it. Comes in many forms. It's very colorful, but most importantly, zoom out high level, you can't predict which asset class is going to come up on top in any one year. We can see if we look back the last 10 years, large cap certainly makes very frequent appearances in the top few rows. But what I like is that this one goes all the way back to 2005. And if we look at 2005 through 2012, what was the top performing asset class in those years? Well, it was the bright orange, emerging markets. I bet if we had looked at that bar chart that we reviewed a couple slides ago about, how many people thought the US was going to be the most dominant asset class, I bet in 2012 that would have been the chart for emerging markets,
Yeah.
right? We just tend to expect the momentum to always continue. And again and again and again, investors are proven that that doesn't happen. They're proven wrong. That doesn't happen. And that's why it's so important to diversify. But, no one wants to be average. Always people want to hold whatever the top performing asset class is here, one of the top three rows. But I got to say, average is not so bad. Even this chart doesn't actually have the diversified portfolio going through the middle. We do have some that do, but if you just take a quick glance at one of those middle rows, 4%, 15%, 9%, a loss of 15, 25%, 15%, 2%. I mean, go across the row, that's not even actually the average. That's just sort of the median of this quilt that we're looking at. It's not bad. And that's, I think, one of the big messages that we have for today is sticking with it in the long term, sticking with diversification and just not messing things up, avoiding big mistakes. And that's what's going to reap the rewards of longer term returns that we have enjoyed in the stock market, like over 10% return since 94 in US stocks, even bonds almost 4.5%. It's not bad. And versus a 2.5% inflation rate, that's some really nice, juicy growth.
Yeah, and I think it's always important. Yeah, I love your point on the average return, because if we can compound average returns over time, that's how we can really build wealth for clients, protect their wealth in retirement, allow them to live, the types of lives they want to lead there. I know, Natalie, you're an engineer, so you always like the math focus, but the math of investing can really work against you. If you think about starting with $100 and you lose 50%, you now have $50. You now need to get 100% return just to get yourself back to even, because you're starting from that smaller base. And that's where that diversification is so important, sticking with that fundamental long-term plan. What I love on this chart, beyond just what are some pretty attractive return numbers, as you pointed out, is the fact that there's one thing on here we can really control, and that's our behavior as investors. And that's not chasing that hot asset class, that shiny object. This orange is at the top, let's get that this year, and this blue one's at the bottom. We don't want any of that, and those sorts of things. But maintaining that discipline, that consistency, you can add up to 3% of relative performance on a year-to-year basis just by being consistent, by being disciplined, all of those sorts of things as we go. And that's a really important aspect. And I will tell you, for the average investor, this 3% that they show, they put it on the top of the line to be nice. What the studies have actually shown is that that's actually a negative 3%. That's 3% worse that the average investor does than the markets by making these decisions to move in and out, chasing that shiny object. Beginning of this year, we heard a lot of questions out there in the marketplace about crypto, Bitcoin. Is that a place to be as it was running up to $100,000? And then now that it's dropped off into the 70s or so, you were getting a lot fewer questions on that, and sort of avoiding that chasing mentality and saying we have a good long-term financial plan. I mean, that's clearly one of our strengths here at Francis Financial. I'm talking a lot today about the investing side, but all of the work that you do on the financial planning side is so critical to that long-term success.
Mm-hmm. And we were just joking about a Wall Street Journal article in which they interviewed investors who said that they sold all or a huge chunk of their stocks during the market turmoil and said, I'm getting out of the market. And I know that there is a common urge to do that when there's a lot of uncertainty, and it certainly feels at the very least like a lot of social and governance uncertainty. The problem then becomes, twofold. One, the stock market could very well go up from here, and we have some data around that. We don't know, it could definitely go up from here. But two, more importantly, when do you get back in? No one wants to get in March 2009, that's for sure. And it turns out the times when it's the scariest to get back in, that's actually when it's most beneficial. So it's just, in terms of making some real strategic plays about getting in and out of the market, that's impossible. And so really an investor's best bet to avoid negative sort of investor behavior that really drags down returns by 3% or more year to year. Diversity is the name of the game. And I think that there's a lot of overlap between sort of health and fitness and investing. And so there are some, just like in health and fitness, regardless of what environment you're in, whether you're on vacation, whether it's a stressful period, whether it's a more relaxed period, whether you're 50 or you're 20, there are some really basic fundamentals that you can follow that lead to better health, exercise and eat right. That's sort of always the fundamentals. And similarly with investing and your personal finances, rebalancing is one of those, tried and true, just disciplined steps that you can take in your portfolio on an annual basis, to make sure that you are doing what you can do and controlling what you can control.
Yeah, absolutely. And that's something we've really been focusing on a year-to-date basis in client accounts. As I mentioned earlier, large cap growth stocks outperformed substantially in 2023, and again in 2024. And so we found that client portfolios have become overweighted to stocks relative to bonds in the portfolio. Bonds provide that nice income, that nice diversification, that downside protection when the stock market declines. This was a chart from Vanguard that I thought really highlighted that. If you go back to 89 and you started with a 60% stock, 40% bond portfolio, and you never rebalanced it, you were up to 80% stocks by the end of that time period. And so that changes a lot, that risk that you're taking in your portfolio, how far that portfolio is going to fall during the next downturn. And downturns are inevitable. If it was a straight line up, everybody would be 100% invested all the time. And the reason we earn return is because we take risk. And so we want to really focus for our clients on making sure they're taking the appropriate level of risk. What does that mean for our clients this year? It's meant some taxes, unfortunately, and I'm incredibly cheap. I try to avoid taxes at all steps, but locking in those profits is really good because it controls the risk in the portfolio. And so if you look there, moving from that 60-40 portfolio, you saw that sort of a range of possible returns was a loss of 26.6, to a gain of 36.7. So down 27, high of 37. That's the possible outcomes. Moving that to 80-20, look at the downside. No one's ever concerned when they accidentally make too much money, I've found. Everybody's okay with that. But in terms of the loss side, instead of the potential for losing 26% in a given year, you could lose as much as 35%. Now that has a really significant impact on how the financial plan plays out, particularly depending on when that occurs in retirement or other phases of your financial planning life. And so you're exactly right, Natalie. Doing those right things forces you, as you rebalance, to buy low and sell high. We're selling those growth stocks in client portfolios while they were high, and we were buying things that were on sale, like those international stocks that nobody liked.
And I always like this chart. So this is a bar chart that moves from the left, 100% bond portfolio, how, what annualized returns to expect, all the way to the right, 100% stock portfolio. What about that 80% sort of bell curve certainty of range of expected returns you can expect in any one year. For more beginning investors who are trying to get a sense of what their risk tolerance may be, I love looking at the bottom numbers of what the potential 1-year loss could be,
Mhm.
starting all the way on the right-hand side and then working your way left. If you say a 43% loss, if you were to see that in a year and it was unacceptable, then that's too risky of a portfolio. Okay, let's move to the left. 90% stocks, 10% bonds. All right, 39% still doesn't let you sleep at night. Okay, move to the left one more, 80 stock, 20 bonds. So just for anyone who's trying to get a sense of their risk tolerance or helping others in their lives get a risk tolerance sort of check.
Yeah, and Natalie, I always like to take it one step further. I think you make a great point, but percentages are sometimes hard to think in terms of. So
True.
start it as $1 million portfolio and say, if I lost $430,000, I think that makes it a little bit more real to people as you sort of think about it and say, okay, that means my $1 million after this year is now worth 570,000. How do I feel about that?
Yeah, that's a great point. I heard this really excellent analogy. It's stuck with me for many years from Dr. David Kelly from JP Morgan, about the importance of rebalancing a portfolio. And we've probably all been in those little like hopper planes. I know I take them often from like Portland, Oregon down to Eugene, Oregon when I'm visiting family, where you walk in and maybe there's like one seat on each side of the aisle, or maybe two seats and then a single seater. And when you're taking off, they're really paying close attention to exactly where you're sitting so that they can distribute the weight evenly for takeoff. And then they say, you know what, look, once we reach our cruising altitude, go wherever you want, sit with your friends, etc. But then again, when we're going to land, you need to get back into your seats to balance the weight again. And similarly, when the market is about to enter a turbulent period one way or the other. So we can talk about, potential downturn or potentially taking off. That's when it's most important to make sure that you are at or close to your target allocation, to avoid, like you mentioned, big losses, but also to capture as much of the upswing as possible. Because, if you are in a substantial downturn and now stocks are a little bit lower in your portfolio than they should be, you want to bring those back up into alignment with your asset allocation to make sure that you can fully take advantage of that recovery. The trouble with rebalancing your portfolio is that you never know. You never know, when am I just at cruising altitude versus when am I going in for a landing or a takeoff. And so just doing it routinely is so important. I'm someone who loves knowing how long the pain is going to last. It really helps me mentally. I know that there are others like me out there. I've met them before. So this is a great chart. It really shows the length of time we have been in bull markets versus the length of time we've been in recessionary bear markets, not recession, sorry, just bear markets. And what I take away from this chart, first and foremost, is if I scan the bottom of the chart, the lower half, which is all the bear markets, I'm seeing that the longest bear market here is, help me, it's kind of small on my screen. It's 1.7 years? Is that what you're
Exactly,
looking?
you got it.
1.7 years. It's not a lot, not a long time. And then if we also look back at more recent history, so 1.7 years, that was in the early 80s. Even if we look at 08, 09, that was just 1.3, basically 1.1 years and then 2 months. So
Yeah.
really not a long period of time that we're in this really painful period. 2022 being the most recent, that was 9 months.
Yeah, I think a really good point. As people, and again, we're starting to hear the recession word. That's certainly not our forecast. That's not the consensus forecast of the economists out there. As I showed you, that's not the Fed forecast. But if that does happen, as you said, relatively short. Certainly shorter than the pain you feel as you run a marathon, I assume. So relatively short experience there. But the other thing that I think is really important about this chart, if you look at, the gray bars are the recession periods. Through several of those recessions, the bull market's continued. So a recession doesn't necessarily mean we're going to see a bear market. And so just because we might see a slowing in economic growth, even potentially go into a recession, doesn't mean we should be looking to move out of all of our investments. Stock market continue to move up. Remember, it's looking at future expectations as well.
That's a really great point, but Matt, this time feels so different.
Everybody's favorite investment words is this time different. And yeah, what I will say to you, this is one of my favorite charts, is this goes back to 1970. So we had the oil shocks in the 70s. We had, international stocks. Japan was going to take over the world in the 80s. We had the tech bubble in the 90s. That burst in early 2000. We had the real estate crash. And, this is a really busy slide. I'm sure most of the people listening can't even read it. And we're happy to send this out to you if you want to take a closer look at it when you have more time. You put $10,000 in the S&P 500, so 500 big US stocks. That has grown to $3 million by the end of 2024, despite all of the reasons, all of the times that were different. We had the bankruptcy of Lehman, all of these things. We had the long-term capital management crash, whatever it might have been. We can talk about geopolitical issues as well. Throughout the time period, companies have found a way. I mentioned that before. We have some incredible companies, some of the best in the world here in the US, but we have some incredible companies beyond the US as well. They find a way to adjust. Once we get through periods of uncertainty, they adjust and they find ways to make profits. And that's what we're tying into when we invest with stocks, is the long-term profit growth of these really incredible global companies.
Yep. And as a reminder, right, that's not a straight line. I love that slide. It kind of looks like climbing a mountain. Anyone who's ever gone for a hike knows it's not only straight up. You do have some dips and valleys on the way, especially the closer you get to the summit. But drawdowns of 5 to 10%, represented on this slide by a very cute little teddy bear. They've happened 43 times since 1945. And on average, it takes about 3 months for the market to reach, recover back to its prior high. We see market losses of 10 to 20%. We've seen that 15 times since 1945. On average, those take about 8 months to return to market highs. Losses of 20 to 30% are much, much less frequent, only 6 times since 1945. And in those cases, it has taken about 2 years for the market to fully recover. And then, really more severe drawdowns of 30 to 60% losses. That has also happened 6 times since 1945. And in those instances, it took about 3.5 years for the market to recover. And so I think what's important about this is when you think about the average time to recovery, that doesn't mean that those 3 years, 2 years, 8 months are negative. The market is negative every single day, because that's the really, really, really painful period, is when the market is consistently negative. You're hearing only negative news. Once the market's kind of in a recovery, it feels easier.
Yeah. It really does. And this, I think, is a great slide to sort of illustrate that, and that, we have drawdowns all the time. We've talked a little bit today about 2024, 2023. Look how good those years were. Up 24% in 23, up 23% in 2024. At the same time, we had drawdowns of 8 and 10% throughout the year. And Natalie's got several of these sort of highlighted there where the arrows are dropping in as well. When you look at a year like 87. 87 was our Black Monday. We had a huge crash all in one day. You see, we had 34% drop, still finished positive for the year. So even if we're seeing, as we've seen, we mentioned earlier on, we've seen a correction from the highs this year. Certainly doesn't mean that 2025 is going to end up negative.
Yeah, and I love this slide. In order to receive those, 8% or more annual returns in your portfolio, you must be willing to tolerate, on average, 3 corrections of 5% per year, 1 correction of 10% per year, 1 correction of more than 15% about every 3 years, and then 1 correction of over 20% on average every 6 years or so. And that's, looking back since 1926. The S&P 500 has really provided positive returns the vast majority of the time. Almost 3 out of every 4 years, the S&P is positive.
Yeah, I think that's really important. And I think, you look at how the markets have behaved, just over the last 3 years. Let's ignore 2025 for now because we are obviously are only partway through. In 2022, we had that more than 15% correction. The market fell quite a bit. But then in 2023, we had a great year. 2024, we had another great year. And so we've really just over the last 3 years, you've seen this illustrated, delivering those great returns, 3 out of 4 years being positive during that time period as well. So I think you've seen how well this works. Our job as investors, back to what we can control, is to realize we have to tolerate these items to get that nice left column.
And so from here, Matt, walk us through what are the upcoming events and data points that are coming out that we and the market is going to be paying attention to.
Yeah, so certainly things that I'm focused on, over the next month or so. On the 28th, we have the PCE data. That's the inflation gauge that the Feds watch the most. We actually think that's going to be a little bit disappointing. We saw some of the key components in the most recent CPI report that go into PCE. So we think we're going to see a little bit of a spike up in PCE when that comes out on the 28th. So we'll be watching that very closely. The market expects that as well. So as long as it's not worse than expected, it shouldn't be a huge impact, but definitely something to watch. Big one, of course, is April 2nd, the reciprocal tariff day. And so I believe this is also referred to amongst the Trump administration as Liberation Day. So I put that in parentheses there as well. This is when we're supposed to learn more about what's going on with these reciprocal tariffs. And so what we had over the weekend, part of what drove some pretty good performance to start this week, is the fact that Trump has started to back off a little bit on those, saying they may not be extended to all countries. Certain industries may be exempted, those sorts of things. So that's a big one for us from an uncertainty perspective, is what happens, a week from today on April 2nd. We then have another inflation data or inflation print that comes out on April 10th. Trying to figure out the trend. As I mentioned, CPI dropped last month. Does that continue down, or do we see a spike back up? The Fed and I think certain investors are expecting maybe a little bit of an up spike. The Fed did refer to the impact of tariffs as inflationary, but said it would be transitory. And so we've got to really watch that closely. April 30th, end of April, we'll get Q1 GDP growth. As I mentioned, we had incredibly strong GDP growth last year. Off to a good start. Some of the tariffs, some of the deportation, some of the layoffs and other things we think are going to negatively impact Q1. So we'll want to watch that very closely. And then, sort of on an ongoing perspective, we're paying, close attention to trade policy. What's going on with sort of the one big beautiful bill that's out there? Is that going to extend those tax cuts? We're going to have some changes there. I pulled another quote from Ed Yardeni here that I thought was good about helter skelter. Described disorderly haste, confusion, or chaos, which seems to be descriptive of President Trump's trade policy overall. And so our word of the day was uncertainty, and I would encourage all the clients on the call to understand we're going to see a lot of jumping around this year from a market perspective as we try to digest and process what that means.
Mm-hmm. And so, in summary, and I'll try to go through this relatively quickly so that we have about 5 minutes or so for questions, but what we're seeing, it's normal. Market volatility, especially when there's uncertainty, market corrections, very, very normal. Intra-year market jitters do not necessarily mean we are headed for another 2022, another, 2008, 2009. We have no idea how this year will pan out at the end. And even though this is normal, still know that it is okay to want some extra support during these times from people who are really accustomed to watching the markets, following all of the data, the economic trends, and who can just be there to support and answer any of your questions, personalized on a one-on-one. And that's what we're here for. We encourage you to reach out. We encourage you to, if you have any friends or family who are really concerned about what's going on in the market, have them reach out. This is what we do. Matt eats this for breakfast so that you don't have to worry about this. So please do know that we are here for you. And I love the Mark Twain quote. I grew up in a town where he lived for many years, on Jackass Hill. And he says, I have spent most of my life worrying about things that never happened. So just a nice little quote to keep everything in perspective. But I'm going to go ahead, stop my sharing. If anyone has sort of any questions for us, we're here to help answer them. We'll give people a little bit of time to chat.
And I did see one person who was driving while they listened and mentioned that they would like to get a copy of the slide deck. We're happy to get that out to you, of course. And
Yes.
please drive safely.
Good point. All right,
Maybe,
well,
Natalie, while we're waiting for a question to come through, I'll mention one of the questions that I've had a lot of times with, from clients in terms of what are we doing? And how are we preparing for what has been increased market volatility? And a couple of the real areas we focused on, as I mentioned as we were talking through, is the fact that we need to get back to our risk targets, lock in some of those gains. Warren Buffett always has a quote that I love, which is, stocks are the one and only thing people don't want to buy when they're on sale. If we go into a clothing store, the first place we run is the sales rack. Stocks, we like them a lot better for some reason when they've been going up and up and up. And so it's our job, part of the way we've adjusted portfolios, rebalancing back, getting the risk levels in line. And we've made some adjustments in a lot of client portfolios on the international exposure that's there as well. Looking at the types of bonds that we're invested in, we see some really attractive bond yields today. Whether the different types of funds, we're seeing bond yields in the 5 and 6% range, and so making sure those all exist as well. And those are some of the small changes we've made in order to position the portfolio to handle the volatility that we certainly expect throughout the year.
So, yep, going back to that rebalancing and being disciplined approach.
Absolutely.
Exactly. I think, yeah, tuning out a lot of the day to day. One of the best pieces of advice that I received was actually from a client who is very politically motivated and active. And her advice was, I read the paper Sunday mornings, cover to cover, so I stay informed, and then the rest of the week I get to work. And I thought that was so succinct and so intelligent to help us stay informed, feel like we know what's going on, and also not let that anxiety sort of seep into our day to day. So for those who may have the opportunity to do that, I know you and I don't so much have the opportunity because we have to keep up with what's going on a day-to-day basis. But I thought that was really, really great advice.
And I think that's an incredible opportunity that we provided all the clients, as you said just a minute ago. Shift that burden to us. We're here, we're monitoring this. I'm looking at this all day, every day. So you don't have to. Lead your life, do the things you love and the things you enjoy. Train for that triathlon, as I know Natalie is working on when she has free time herself. Do those things. Let us take that burden from you.
Exactly. So I'm not seeing sort of many questions come through. Maybe everyone's eating lunch, driving, those sorts of things, which is just fine. Like I mentioned, if any questions arise as you digest everything we've talked about today, please don't hesitate to reach out to us. We're always happy to be there as your support system, let you know our thoughts, speak one-on-one, take an extra X-ray review of your portfolio. And thank you so much for spending an hour with us today. We really, really appreciate it, and we are here for you. So thank you, everyone, and thank you so much, Matt.
Yes, thank you.
All right.